Hey everyone, hopefully you're having a good day. My name's Andy. My channel's Finding Value. Today we're going to go through Twitter, see what people are sharing on social media, generally related to finance, wealth building, and/or commodities. I'm going to interject my financial opinions as we go. So let's see what's going on with social media today and what's being shared. You can find me at finding_finance on Twitter, and you can join our community, finding-value.com, where I dive deeper into these topics, subjects, and answer your questions on the weekends. And you can see what I'm buying and when I'm buying it. LEAP coupon code is still active. So coming to August, we have Petrol Bross. Union votes to pay 50% of dividends withheld from Petrol Bross. Petrobras will pay extra dividends in 2 installments with the ordinary dividends. Petrobras will decide at the extraordinary meeting on another 50% dividend by December of 2024. So they have been going back and forth with Lula, the president, who basically came out a couple of weeks ago, or maybe it's a month ago, and said they're not going to pay the special dividends. They're going to have to invest it in renewables and do all this BS. And people did not like that. It had a strong sell-off. That sell-off is proving to be a good buy point to add shares at a few dollars cheaper per share. And now they're coming back stating, "Oh, well, yeah, we're gonna pay those dividends out." it's 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 shenanigans, is what it is. It's shenanigans, and I understand why people maybe don't want to deal with state-run or owned companies. Makes sense, and the way that I look at it is, if you are going to own some of these, you're going to have to allocate a certain percentage, and just know that there's going to be shenanigans that get played with it. Jesse Felder says commodity prices are moving higher, driven by the following: reaccelerating U.S. growth, geopolitical uncertainty, segmentation of global trade, and strong AI demand for energy. I would disagree with that. Um, those are all short-term narratives that people put to a commodity bull market. What I think is actually driving it is demographics on the long term. These are all shorter term plays. The longer term is demographics are driving it. The credit problem of the Federal Reserve and the government, those two entities that are creating credit and running deficits, is creating the problem. And we've got deficits or shortages on the supply side, potential underinvestment in a lot of sectors that are driving this. These are all short-term market movements outside of maybe AI demand. That's kind of a new entrance to the longer-term fundamental view for electricity demand. But none of these are the actual, we'll call it the 40,000 foot winds pushing everything. None of these are in this. These are all short-term garbage for the most part, with respect to the longer term 40,000 foot view. The 40,000 foot view is the demographic creating credit through monetary expansion. And since interest rates have kind of held that down, it's the fiscal spending that's driving it. And then the inherent deficits in commodities. Everything else is just a narrative that people bring up to try to explain the move. So the move from 2000 to 2008, that move there is the demographic, the home buying, and credit expansion. Everything that they say in between those 2 points is all short-term narrative garbage, in my opinion. Then we went into the large 3-hump consolidation, which is 1 hump, 2 hump, and then the 3rd hump. That's 3-hump consolidation there. And we've broken out of that consolidation. The consolidation that occurred, the 3-hump consolidation, is the recovery phase of real estate. It is the lack of inflation and low interest rates. It's the market conditions. None of this is impacting the market conditions in macro fundamental view. And then what you're going to see is that when this money rotates into this, it's coming from other sectors. So you're going to see other sectors underperform during this commodity bull market. It's going to be technology that's going to underperform most likely, like we've seen in the 1970s. And it's going to be other stuff like bonds. Bonds have already been getting smoked. So now the money's rotating into tech, and that money will eventually rotate into commodities. And we're going to get a big surge higher in commodities. Very big surge. And this fractal here looks very much like this fractal almost here in this section down there. But we'll see. Grady says, I'm not a perma-bull because I post bullish big picture commodities charts, or a gold bug because I'm bullish gold in a resumed secular bull. No, commodities are simply in a new super cycle bull since 4 years ago. Just trying to help people get on the right bandwagon. This is what I'm going to say about Grady. The guy is nuts on. He is nuts on. In fact, he's on. His opinion, in my opinion, is so much more on than almost anyone else that I see. He's put together, whether he's putting together all these different charts or whatever it is, he's nailed a lot of stuff. He's got his finger on the pulse, is what I'll say. And this, what he's showing here is a 60-year bullish falling wedge, CRB index versus the Dow Jones. And we've got a probable false breakout and the move higher here. And we're probably going to break out of this and go to some ridiculous level where commodities just do crazy things. Commodities are the feed or the building block of wealth. Energy and commodities. When you combine those two together, you create machinery and then you convert commodities into usable products. If you're short on the front end, money is going to rotate up to the front end to solve front end problems. The back end, which is downstream from commodities, the manufacturing, powerhouse companies, Apple, aerospace, trucking, John Deere, all those things. Money's going to have to rotate upwards to solve the commodity problem if we have a commodity problem. And the things that are needed the least are going to get hurt. So coming on down, we got why are U.S. natural gas prices so low right now? One factor shaping the market is the surplus of gas and storage. Storage helps utilities and others balance supply and demand across seasons. U.S. gas inventories are currently 36.6% above the 5-year average. So you can see last year that we were above the 5-year average. We didn't get a cold winter. It was pretty warm. And that impacts the entire world. It not just impacts the United States, it also impacts Europe, where they don't have to import as much liquefied natural gas as well. So you can see that this is real high. We went on the high end the entire time, and now we're still building on the high end. So we didn't draw it down through our weather the last 2 winters. It's been pretty mild. If we do get cold winter next year, this could reverse very quickly. So I think that we're at a very good opportune time, and I'll show you a couple more, some more data on natural gas below on how cheap we are historically. But right now, it's going to take some time. This is a longer-term play, going to require patience, and natural gas is really cheap because of these higher inventory levels and the warm weather the last 2 things. And I'm just going to say this, natural gas is subject to weather immensely. It's not just heating demand. Because now, if you look at the derivatives of natural gas, which is solar and wind, weather can destroy solar through large hail. So solar can be destroyed and wind can be destroyed if you go through a tornado or hurricanes or wherever it's located. All of these things can be destroyed with time. And then the weather is ultimately going to determine the total demand for natural gas. And this storage level, it seems like a lot compared to history, but the days of coverage continue to go down given our demand that continues to go up. So this is going to move up and down more rapidly if a problem does come into the system. Here's HFI research. Repeat after me. This is not a real OPEC plus cut. And look, OPEC plus continues to pump oil. They're not cutting. There's no cut here. They barely outproduce the numbers that they're at just for 2023. They're not cutting, guys. So if we're drawing down on our inventory and they haven't cut, where's the extra oil going to come from, guys? Where's it going to come from? Coming on down, North Star. Gold miners need to outperform the SPX by 100% just to get to the start line. By beating the SPX by at least 165% after that, and a total outperformance of SPX by 440 to 700%. We might get to the end of the bull market, think it can't happen, think again. And there's the projected move of the major bull breakout line, 100% upward. We break that, then we're looking at 165% outperformance to get back to this level here. And then a full revaluation back to 2011 would take a 718% outperformance against the S&P 500. That doesn't mean it goes up 718%. What that means is it goes up 8 times whatever the S&P 500 does. So if the S&P goes up 100%, it needs to go up. If it doubles, it goes up 1,600%. And that's the gold miners ETF. That does not mean that some of the individual companies could go up 2 or 3x that. Some crazy stuff could occur, is what he is basically saying. The biggest investing errors come not from factors that are informational or analytical, but from those that are psychological. And I would agree with that. Most of my errors in history are psychological. They're not from an information or analytical standpoint. So I would agree with that. It's 100% right. Copper crazy. BHP's all-share bid for Anglo American hits $39 billion, aiming to forge the world's largest copper miner, controlling about 10% of global supply. As 2024's biggest deal, it's poised to trigger intense antitrust scrutiny. And that's, if they were to merge, would be BHP and Anglo, and that's how much they would produce of copper. A mining giant for copper, about 10%. Josh Young states Goldman sees current onshore U.S. oil production about 100,000 barrels per day lower than their forecast and 400,000 barrels per day lower than the Q4 2023 peak. Are we going lower here, guys? Do we have a production issue problem of crude oil in the lower 48? I don't know. The majority of the gains looking backwards came from lower 48. If we lose production growth out of the lower 48, this could get very interesting in terms of world oil production and if we can grow world oil production. If this starts to decline, some of the projections of growth may not materialize. They may actually decline, which would be a large difference between growth projections and actuality. It could be millions, measured in millions of barrels of difference. So then if OPEC isn't really cutting, if they're kind of flat out producing, Saudi Arabia would be left with about the only spare capacity left in the world. And my question is, would it be smart to pump it, or would it be smart to keep at least a little bit of spare capacity left? I don't know. We'll see. But this is interesting information here, where oil could really start to get moving. Charlie Munger says, conservative investing with steady savings without expecting miracles is the way to go. So let's read this quote here. by Charlie. He says, it's in the nature of stock markets to go way down from time to time. There's no system to avoid bad markets. You can't do it unless you try to time the market, which is a seriously dumb thing to do. Conservative investing with steady savings without expecting miracles is the way to go, in his opinion. And a lot of this deals with stretching out time frames. To stretch your time frame out and not be focused on the short term. You have to pair that with psychological strength and conviction. Conviction can get you there, but you also have to have the stomach to ride out some of this volatility. The short-term market pricing isn't what is driving or should drive your potential decisions. It should be the longer term, bigger picture view and the value that you're buying in the business is what they'll say. So you're looking at the disconnect between short-term market pricing and fear with the underlying value of the business. And then you're looking and exploiting at the difference between the price and the value of the company. And then taking a long-term time horizon to wait for that market condition or valuation to change where the value and price goes up and is better valued or hopefully becomes overvalued. What is the cheapest asset on earth? Using artificial intelligence, I have calculated the approximate gold to wheat ratio in ancient Rome. One gold could buy 12 barrels of wheat. Today, that same gold coin can buy about 351 modi of wheat or barrels of wheat. One thing I will say is we've gotten a lot more efficient at growing wheat. And with time, as some of these metals, we've gotten a lot more efficient at yanking them out of the ground through equipment. I do think that the declining ore grades could change that dynamic. So yes, I think we're going to continue to get more efficient at bushels per acre or whatever you want to measure it at. But I do think that we are going to slow down in actual flow of metals because of declining ore grades and because of depletion of reserves. Combination of those two things. So the flow rate out of the ground might not be matching an earlier time frame where the reserves are higher and the ore grades are higher. That's what I'm saying. Welcome to the era of stagflation. So U.S. economic growth slows to 1.6%, and inflation likely heats up with the PCE price index rising above expectations to 3.7%. So growth is slowing while inflation is accelerating. And that's the era of stagflation. That's exactly what it is. Another quote here, really good investment opportunities aren't going to come along too often and won't last too long. So you've got to be ready to act and you have a prepared mind. Good quote. Bursting of the mother of all Nasdaq bubbles will be one for the ages. So in his opinion, he's looking at this. This is the nasty Nasdaq at a potential double top or the Batman pattern, and then a big move to the downside. Is that going to occur? I don't know. A lot of people are talking about and trying to project recessions and market pullbacks. But what if this time is a little bit different than previous times that throw people off? A lot of people look at bonds to see if people are positioning in bonds. What if we don't get a pullback in bonds? What if we don't get a pullback in yields? What if people don't rush to bonds? Can we still get reliable signals from the bond market if it just continues to go up nonstop? I don't know. And maybe that is a dynamic that has changed in the market where the yield curve inverts, but it's broken. And with how much they are releasing in bonds and have to release in bonds continually, maybe yields continue to go up. I don't know, but maybe something is different versus history that we used bonds as an indicator, yields dropping for a potential recession. Maybe yields are going to go up and we get the Nasdaq to go down simultaneously. Maybe. Here's silver. SIL is the um, silver miners index that we're looking at. So that ratio of SIL to silver ratio looks ready to break out, providing miners with some pretty good leverage to silver's next leg up. And guys, silver moves fast, which then makes me believe that SIL could go up very dramatically, very dramatically, very, very, very big moves in very short periods of time if you get the right market conditions to align, which I think is aligning right now. Oil to natural gas ratio back up towards these highs, and we're at very cheap levels for natural gas against crude oil. So natural gas could be an incredible investment if you can stomach a little bit of volatility and patience. You're going to have to apply some patience here because we do have a little bit of an inventory glut. And that's why we're this cheap. Kobayashi letter says, for those who do not understand what just happened, first, Q1 2024 GDP growth slowed to just 1.6%, which is less than half of the 3.4% Q4 2023 number. This reading is roughly 50% below Goldman Sachs expectations. But it gets even worse. At the same time, the U.S. core PCE price index soared from 2% to a staggering 3.7%, aka the stagflation that we just talked about. This crushed estimates of 3.4% and further suggests that inflation is on the rise. We have a weakening economy with rising inflation, the worst possible outcome for the Fed. That is true. Stagflation, baby. Investment wisdom, nobody can predict interest rates, the future direction of the economy, or the stock market. Dismiss all such forecasts and concentrate on what's actually happening to the companies in which you have invested. That's a pretty good thing. Commodities are a little bit different. They are very much subject to macro forces. So inflation, yields, and all those different things. So there's definitely a time to be invested in commodities, and there's definitely a time where you got to get out. That's where you use ratios to see what's cheap compared to history. And that's what we've got for today, guys. I'm going to end it there. So give me a thumb up for the content. Subscribe to the channel. Subscribe to the website if you haven't already. And we'll see you guys Saturday, 7 a.m. for the question and answer session that we've got coming up. All right, guys. We'll catch you later. This is Finding Value.